They say that 100% finance or 100% loan to value doesn't actually exist. Theoretically, that's not actually true. In this video, I'm going to explain to you how you can buy a property without actually putting down a deposit. My name is Gindy, I'm one of the senior advisors at Create Finance. Let's get into the video. When buying a property, raising a deposit could be that barrier between you buying that dream home. You could be deemed as asset rich and cash poor, meaning that you're struggling to raise a deposit, meaning that you may have plenty of equity within your properties, which can be used as a collateral for a deposit. By lenders taking a charge over your other properties, this is where your first example of 100% finance comes into play. 100% finance is normally packaged as short-term finance, or most commonly, it's known as bridging finance. I'm going to give you some examples of how bridging finance can be used to acquire your dream home. Let's take the first example. If you're going to auction, typically speaking, you need to complete within 28 to 35 days. Now, with bridging finance, you can take a charge over your existing property as well as the new property that you're looking to buy. Because it is quick finance, it will allow you to complete within 28 to 35 days, meaning that you're capturing your dream home. Now, if like me, you like to scroll through Rightmove most evenings and you've seen a dream home that you really want to buy, but you've not sold your current property, what lenders will allow you to do is take a charge over the existing property as well as a new property that you're looking to buy. So effectively then, you can get your dream home and then wait for your existing property to sell, and then you can repay the finance that way. If you're looking to buy a property that is deemed as uninhabitable, so it doesn't have a kitchen, working electric at all, or it may be no roof on the property. If you've got properties in the background which have some sort of equity within that, lenders will allow you to take a charge over the new property that you're looking to buy, as well as your existing properties, and you can actually carry out the refurbishment work on the new property you're buying, refinance it, or sell the property later on down the line and repay the finance. Now, we've talked about refurbishments, let's talk about conversions. More commonly at the moment for investors especially, investors are looking to buy a property and convert it from potentially like a 3-bedroom to maybe add on additional rooms onto the property to increase the rental yield. Now, that is possible, taking a charge over any existing assets that you may have, plus the new property. So once the conversion work's been carried out on the property, you can then refinance to pay off any existing short-term finance. Let me tell you some advantages of short-term finance and bridging loans. It's quick. So you can actually complete on short-term finance from anywhere from 2 to 4 weeks on average. And another advantage, the interest is rolled into the loan. Effectively, what that means is that you potentially don't have a monthly outgoing. You can still service the debt on a monthly basis, but the option is there to have the interest rolled into the loan. And another advantage, which is what we've covered off, it's great when you're looking to buy a property which is deemed as uninhabitable. Once you've done the work on it, it can then uplift in value, so it potentially can be a good investment for you as well. One thing to be wary of short-term finance is that effectively it's short-term. So what that actually means is that it can be only valid for 12 to 24 months. You would need to have a credible repayment strategy to repay back this debt, and lender would need to see that as part of the underwriting process. Let's talk about some of the repayment strategies that you could have. If you're looking to buy a property that requires refurbishment, then you're effectively looking to sell the property. So a refurbishment then to a sale would essentially pay off that debt. If you're looking to refurbish a property, then potentially have it for a long-term rental. A credible repayment strategy could be a refinance of that property. Let's talk rates on loan to value. Typically speaking, on this sort of finance, because it's deemed as slightly riskier from a lender, you would be essentially paying a higher rate of interest. From a loan to value point of view, there would be a restriction of anywhere between 60 to 65% loan to value. That's included any fees and interest as well. If you don't have assets in the background, but you are looking to get onto the property ladder, another scheme that you could potentially go for is shared ownership. Now, with shared ownership, you're essentially buying a share in the property, and the percentage share that you've not bought at all, you're renting from the housing association. Dependent on market conditions, lenders may have products available which require you to put down zero deposit at all. So essentially getting 100% financing on the share that you're buying. Shared ownership mortgages makes it a fast and affordable way of getting onto the property ladder. To find out more about how you can get a mortgage with zero deposit, make sure you check out this video.